Hi everyone, my name is Bridget D'Souza and I'm the writer, tax accountant, and parent behind the website civicparent.org. Welcome to my online property tax and revaluation workshop. I've given this workshop in live format at my parish, St. Aidan's, the St. Peter's University Church, but I wanted to also make the content available online in short, easy to view segments. This segment is titled, What is Revaluation? Here's what we'll cover over the next few minutes. Assessed value versus market value, understanding what these two terms mean and why they are important to this discussion. We'll talk about the two major impacts that revaluation have on your tax expense, and we'll walk through a simple example to wrap it all together. My hope is that anyone watching this right now can grow a little bit more confident in understanding this topic, and that you will share this with friends and neighbors so that more people in the community can get empowered about property taxes and revaluation. Before I jump in, some quick but important fine print. I am a licensed CPA, but this tutorial is not accounting or tax advice. This is for informational purposes only. I'm doing this on a volunteer basis. This is for the community. I live in Jersey City. I care about people understanding this topic. I think it's important for as many people as possible to grow empowered in their understanding of this topic. If you do need specific help with your property or navigating this process, it's important to reach out to a licensed professional who can engage you directly. That might be an attorney, real estate agent, appraiser, CPA, financial advisor, etc. I've got more information on my website, civicparent.org, so you can check that out separately. Okay, let's get into it. What is revaluation? The first thing to highlight here is the word value. Property revaluation is about updating the value of your property. But what value exactly is being updated? To answer this question, we have to first get grounded in a very important fact, which is that your property has, at any point in time, two values associated with it. The first value is assessed value, and this is the value according to the government. The second value is market value, and this is the value according to the real estate market at large. Let's look at these two values in a bit more detail. Assessed value is the value listed in your tax record, which I've got pictured here on the top right of the screen. Your tax record is public data, meaning anyone can access it, and it's got a lot of useful information in it that defines your property. One piece of data in your tax record is your assessed value. This is what's used to compute your tax expense. Probably the most relevant thing about assessed value in context of a discussion about revaluation is that assessed value is only updated at certain points in time, meaning for the most part it's a static value. It only changes when the government chooses to update it. And the most common reason it's updated is through a citywide property revaluation. The second value your home has associated with it is market value, and this is the value according to the real estate market at large. So for instance, if you sold your house in an arm's length transaction, the purchase price typically would be considered the market value. Market value is in flux all the time, and it's based on countless factors that are occurring in the real estate market at large. In my opinion, the person most able to speak to you about market value and why it's changing and how it's changing is a local licensed realtor who's familiar with the price points in your neighborhood. Okay, so let's recap. We have two values, assessed value and market value. Assessed value is the value according to the government, and it's essentially a static point-in-time valuation, while market value is a continually fluctuating value. With this foundational premise in mind, we can move on to what exactly happens with a property revaluation. Okay, ready? Let's get to the heart of it. Revaluation is this. It's the city government going through a formal legal process of updating all the assessed values to be equal to the market values. So throughout the entire city, each property's assessed value is updated to equal that property's market value. Revaluation is based on state property tax law, and the city is required to do it. The city is required to keep assessed values current with market values. So generally speaking, revaluation is supposed to occur whenever market values start to grow disconnected or out of sync with assessed values. That's what the law says. Let's put this into context of an example. Let's say we have a home in Jersey City that has an assessed value of $104,000. Let's say the $104,000 is based on the 1988 assessment. This is true for a lot of properties in Jersey City, by the way. The assessments are based on 1988 values. But now it's 2017. The home is now worth $300,000. So revaluation is the process of updating the assessed value from $104,000 to $300,000. That's revaluation. Revaluation results in two big changes to your tax expense and to the city's property tax system at large. First, all the assessed values in the city are updated to equal market value, as I explained in the previous slide. But secondly, and just as importantly, the general tax rate is updated. The general tax rate is the rate reflected in your tax bill. In Jersey City, the 2016 rate was about 7.7%. After the revaluation, the rate will decrease to about 1.6%. This 1.6% is based on very recent information released by Jersey City and Appraisal Systems, the firm conducting the revaluation. Let's step through an example to pull these various concepts together. Let's say we have a house, like our sample house earlier, that has an assessed value in 2017 of $104,000. Okay, so this is a pre-revaluation assessment. The tax rate is 7.7%. If we multiply the $104,000 times 7.7%, we have about $8,000 in tax expense. But then revaluation happens. The $104,000 is updated to be $300,000 because $300,000 is the true current market value of this home. The tax rate also gets updated. It goes from the 7.7% to 1.6%. We then take these new numbers, the $300,000 new assessment times the 1.6% new tax rate, and we see that we have a new tax expense of only $4,800. When you compare that to the $8,000 this homeowner was paying prior to the revaluation, you see that the tax expense actually went down. So while the assessed value went up, tax expense went down. So this is an example of tax relief. I should note here, some homeowners will experience tax relief, other homeowners will experience tax hikes. Some homeowners might experience very little or no change at all. Revaluation is what we would call a revenue neutral event, meaning the total taxes collected by the city does not change with revaluation. All revaluation does is change who pays what. So some homeowners will see their taxes go up, some will see them go down, some will see them stay the same. It's a redistribution of who pays what. Let's recap. Your home has two values associated with it, assessed value and market value. Revaluation is the process of making assessed value equal to current market value. We also learned that revaluation involves a tax rate change. And we stepped through an example to pull this all together. Okay, that's it. I hope this was helpful. Please spread the word, share this tutorial, share what you've learned, try and explain it to your friends and neighbors. Email me with any questions. My email is bridget@civicparent.org. Thanks for listening and take care.